cartoon sums up current situation. Both US and Iran are at the loggerheads, and each one is in a difficult situation. While it is difficult to predict what President Trump will do, we believe right now we are pricing in this scenario. A stalemate is a victory for everyone. US, Israel will try for opening of Hormuz. They will claim victory by saying oil prices are in double digit and nuclear threat has been reduced. Iran will say our regime continues and maybe we will collect toll from the Hormuz. Iran also becomes more radical and less competent as their top leadership has been wiped out, and they will be ruthless to internal dissent. The world will change from rule-based world to might is right, and all country, including India, will focus on energy independence, defense independence, and supply chain independence for critical raw materials. Next slide, please. Vessel movement in Strait of Hormuz have come down to almost halt. And while there are lots of conflicting views and claims, the reality is that the world is suffering as almost 12 to 13% of global energy supply is not able to move. Next slide, please. How is the world coping up with disruption in 12 to 13% of supply? Well, all of them are withdrawing from strategic premium reserve or whatever inventory they are carrying. The red line indicates where current global oil inventory is there, and it's sharply declining if this war continues. Next slide, please. The challenge is even if the war comes to an end today, the refining capacity has been hit. The oil and gas infrastructure in Middle East has been hit. The shipping lines have been choked. Hence, normalization will take about 2 quarters. Next slide, please. Invariably, higher oil prices have resulted into global recession. We saw that during First and Second Gulf War. We saw that during Iranian Revolution. The reality remains higher oil prices invariably raises energy prices, inflation, and hurt economic growth. Next slide, please. What are the silver lining in the dark cloud? One, the cartelization of OPEC is breaking down. United Arab Emirates, which produces 3.5 million barrels of oil and whose capacity is estimated at 5 million barrels, has moved out of OPEC, a cartel of oil producers, from 1st May. Hopefully, they will produce 1.5 million barrels extra whenever possible. Looking at UAE, Russia, Saudi, other Middle Eastern producer may start producing more oil and oil prices will come down. This is positive development. Next slide, please. Partly reflecting such development, oil futures are inverted. December oil are at 80 handle. Obviously, this changes on a daily basis, but oil prices could come down if OPEC's production monopoly is destroyed. Next slide, please. Coming to global economy, so far, both financial and real markets have held, partly because government absorbed loss, partly because oil inventory were drawn from strategic petroleum reserve. Net net impact of war is not yet visible in global economy. Next slide, please. As normalization will take time, forecasters have reduced growth forecast across the globe and raised inflation forecast across the globe. Next slide, please. The macro factor obviously depends upon each country, but certainly developed market like Europe seems to be at more risk than countries like China, Brazil, which have more independence on energy. Next slide, please. The central banks, since subprime crisis, have fired all their bullets and they pumped their economy. Post that, many of them have contracted their balance sheet post COVID crisis 2022, 23, 24, 25, 26, and 27. It is expected that central banks will reduce their balance sheet as a percentage of GDP. Thus, they will have firepower in case global growth demands it. Next slide, please. Despite all the uncertainty, equity flows like in India has continued to come to global equities, and after 2021 it's likely to exceed $1 trillion this year. Next slide, please. The one risk factor which world will be watching carefully is Taiwan. Will China make a move? President Xi Jinping would like to unite Taiwan into China. America is engaged in Middle East. Anti-war feeling is present, persistent in US. And most importantly, American arms and ammunitions have depleted. Will China move on Taiwan? If yes, we are likely to see more disruption and far bigger impact than the Middle Eastern crisis. Next slide, please. Coming to China, their capacity utilization has started coming down as more and more new capacities are coming on stream. Next slide, please. As capacities came on stream and sales declined, Chinese inventories have gone up. At some point of time, that inventory will be unleashed on global market. Next slide, please. China remains an economy where investment leads and consumption continues to remain subdued below its peer group average. Next slide, please. China also made a difficult transition from real estate dependency after building ghost cities and highways which no one was using. China pulled the plug on real estate sector, and now real estate prices have corrected where it was in 2005. Chinese real estate today is available at 20 years before prices. Next slide, please. The pivot of China from real estate to modern technology is humongous. Today, China's spend on R&D is more than US spend on R&D in absolute quantum as well as a percentage of GDP. Across the board, China dominates manufacturing from textiles, vehicles, electronics, all the way up to metals and machinery. This makes China formidable player in global economy. Next slide, please. China has focused on domestic oil production and increased its oil production from about 3 million barrel to almost 4.6 million barrel today. Next slide, please. All these things, some positives, some negatives, put together, China has weathered the crisis well, and their economy grew in mid-single digit at fastest pace in 3 quarters. Next slide, please. Coming to US economy, US has become world's largest crude oil producer, producing almost 14 million barrels on a daily basis. Next slide, please. On the Liberation Day in early 25, President Trump shocked the world by imposing tariffs. From that day, job growth started declining and inflation started inching up. This does not take into account refund of tariff instructed by the Supreme Court. Put together, tariff caused damage to global growth, but it has not kept America immune. America has also paid price by way of higher inflation and lower job growth. Next slide, please. However, savior of America is investments by hyperscalers. Put together, almost $700 billion will get invested in hyperscaler. This has supported American growth. Next slide, please. The first quarter 2026 GDP growth came ahead of expectation at 2% thanks to AI-led investment. Next slide, please. Will AI-led investment continue? Well, difficult to say. But if we see in the past, companies like Uber, Tesla, Netflix burned cash to build something. Compared to them, OpenAI is spending multiple times. Put all of them together. Will this help in building something in future, or this will go down the drain? Who knows? But the pace of cash burning in artificial intelligence is one of the highest. Next slide, please. This is coming at a time when America is witnessing large deficit. If we look at 6 months between October 25 to March 26, the total receipt is about $2.5 trillion. Total spending is about $3.7 trillion. The total deficit just for 6 months is $1.1 trillion. On a yearly basis, annualized, it could be $2.2 trillion. America is a large economy, but $2.2 trillion is also not a small number. Next slide, please. Consequently, the debt of America remains elevated at $39 trillion. On a $30 trillion economy, debt of $39 trillion is substantial. Next slide, please. Despite American government running large debt, corporate America is doing extremely well, and for next 3 quarters, the earnings growth is likely to be in double digit. In fact, at 20% year on year, much higher than India. Next slide, please. Some of that profit growth is also coming through productivity increase thanks to AI, and a side effect of that is retrenchment of employees. Number of employees in S&P 500 companies fell compared to previous year. This trend is likely to accelerate in 2026 as more employees will be retrenched to invest for AI. Next slide, please. Global investors own substantial amount in America. In equities, they own about 20 trillion, or roughly one third of their total market cap of $60 billion plus. They have invested $19 trillion in foreign direct investment and $16 trillion in debt securities, including US Treasury. Collectively, global investors have invested $66 trillion in US. Next slide, please. Now, we have seen tariff pushed inflation higher. Can the impact of war through higher petrol diesel prices result into another cycle of up move in inflation? If that happens, certainly US economy will come under trouble. Next slide, please. The dollar index has corrected from high of about 111 to 98. This has taken out returns of global investors by almost 10 to 12%. Will investors continue to par money on US, or will they take out? If money starts moving out of America, there are better chances that India will also receive some flows. Next slide, please. The history does show weak dollar result into withdrawal of money from America. Will history repeat? If yes, then India is likely to get capital flows. Next slide, please. Coming to Indian economy, on a longer term basis, next year we will reach where we were in the early 60s as a percentage of global market, global GDP on a per capita basis. We were 20% of global per capita GDP in the 60s. Through inward looking policy, we brought it down by 90s to about 6.5% of per capita GDP, from 20% to 6.5%. With liberalization unleashed by Manmohan Singh and Narasimha Rao, we slowly crawled back up, and today we have the same percentage of global per capita GDP as we had in the 60s. However, this long-term picture does get impacted by what happens in the current situation. Next slide, please. India's oil demand is rising faster than global oil demand. China is launching electric vehicles. The world is using solar, nuclear, and other energy sources. Unfortunately, our growth is higher. Growth requires energy, and hence our demand is growing at a faster pace than the world. Next slide, please. We are also not able to produce enough oil and gas locally, and hence the trade deficit on oil goes higher because of the local consumption. Even when oil prices have come down, our oil import bill has gone up because of the additional demand. Next slide, please. The LPG consumption, thanks to the Ujjwala scheme of the government, which provided gas cylinder free of cost to rural poor household, our LPG demand has gone up, and so has imports in absence of local production. Next slide, please. We are in a tough spot. Next slide, please. Next slide, please. While previous slide, please. While we have reduced oil sensitivity of Indian economy by focusing on solar energy, imported oil and gas. Next slide, please. Compared to our peer in like Indonesia, China, we remain vulnerable to higher oil prices. Next slide. This year, for last year, FY26, the direct tax collection grew by 5%. The expectation was that it will grow by about 11%. Undoubtedly, FY26 fiscal deficit is unlikely to be achieved even based on revised estimates, thanks to what happened in the month of March, resulting into sharp drop in tax collection. FY27 scenario doesn't look too good. Next slide, please. The government has absorbed current energy shock mostly, except some pass on to the corporate India. This means not only FY26 revised estimate of fiscal deficit at 4.4% is at a risk, but also FY27 budgeted estimate of 4.3 is at a risk. The fiscal deficit is likely to be higher based on severity of Middle East crisis and price of oil and gas as well as fertilizer. The economy will get hit by higher oil subsidy, higher fertilizer subsidy, higher gas subsidy, and supply chain disruption. Next slide, please. Our current account deficit is likely to widen for FY27 and may average 1.5% for the next 5 years. Next slide, please. In the 90s, when oil prices shot through the roof thanks to Saddam Hussein's invasion of Kuwait, we had to pledge gold to borrow money, to borrow FX loan. This year, we are in a better situation at $700 billion of gross FX reserves. We have ability to withstand higher shock. Higher oil prices will undoubtedly impact us, but thanks to the reserves, we will be in a position to manage. Courtesy the widening of deficit, rupee has depreciated sharply. Where are we doing? The rupee has depreciated sharply, and we will see further pressure on rupee in the days to come. As they say, troubles come in battalion. Apart from geopolitical crisis, we have challenge on monsoon. This year we are expected to witness below average monsoon at 92% of long-term average thanks to El Nino. El Nino normally impacts food inflation, food production, and rural economy. However, this year's El Nino is likely to impact August and September rain. If June, July rains are fine, that will certainly negate adverse impact of El Nino. The other thing to watch out for is Indian Ocean dipole. If IOD is positive, adverse impact of El Nino is reduced. As of today, IOD is positive. Let's hope and pray it continues the same in June, July, August, and September. The job situation continues to remain where it was for both IT as well as non-IT sector. There is some sluggishness in IT sector openings as companies are careful in recruiting courtesy AI disruption, but non-IT sector openings are compensating for the same. Credit growth for FY26 is one of the highest in recent times. This supported growth to cross 7%, but now banks are operating at 82% credit to deposit ratio, which means incrementally their ability to lend will be under constraint. For us, the biggest challenge remains AI disruption. 4 crore Indians directly or indirectly work in IT related sector. BPO, KPO, GCC, IT services collectively is at risk if India doesn't adopt AI in a meaningful manner. IMF recently showed that India slipped from fourth largest economy to sixth largest economy as our currency depreciated. However, they believe by 2031, India will become third largest economy. What was likely to happen around 28-29 is delayed by 2 years. because of the rupee depreciation and base revision. Converting this into equity markets, while on a 52-week basis, small and mid cap have seen correction at the median level, but much less at the index level thanks to sharp recovery in recent time. The bounce back from the bottom of March 2026 is reasonably good for small and mid cap, whereas large cap continues to trade little subdued. Sectorally, capital market, defense, power, three sectors where countries will focus for their security and independence have done well, whereas banks, tourism, auto and rural, thanks to El Nino fear, has underperformed. Market cap to GDP ratio has come down from about 129% to 115%. On a PE basis, large cap now is around its historical average. Small and mid cap are at a little premium compared to their historical average. The FII selling continued in April. In the first 4 months of this year, they have sold more than what they had sold in whole of last year. The FII selling has brought down India's premium to other emerging market peer group. It is expected that if oil reverts back to $80 a barrel and supply resumes, the earnings growth for next year could still be double digit. Our contribution to global market cap has fallen from 2024 high and now is around our historical average. Due to underperformance of Indian equity, our share, our weight in MSCI emerging market index has collapsed from 19.4% to 12.3% in last 2.5 years. And today, TSMC, a Taiwanese company's weight in MSCI emerging market index is more than entire India. The savior to equity market has been all of you. Thanks to your hand-holding, domestic investor flow has continued. In the month of March, we received highest investment. Put together, these flows have ensured that equity markets have withstood FPI selling. One good thing, promoters have started doing bottom fishing and some companies are announcing buybacks. Some companies are announcing preferential allotment to promoter. At least at this prices, it is fair to say some promoters are finding value in their stock. War normally, the market normally ends before the war ends. This was observed in Kargil, in Russia-Ukraine war, and maybe it will be true for current Middle Eastern war. Over last 2 years, many sectors have been derated as earnings growth failed to meet expectations.
Consequent to that, their valuation also got re-rated, bearing sectors like cement, metal and utilities, where performance was above expectation and valuation got re-rated. In other sectors, valuation got derated. A case in point is telecom sector, where earnings grew at 55%, but yet derating happened as market had discounted that in advance. We believe our markets are likely to remain volatile, subject to how events shape up. Oil prices will continue to impact our economy. Availability, also thanks to geopolitical risk, is under constraint. Supply chain disruption across sulfur, fertilizer, chemical, helium, etc. will impact our economy. Equity pipeline has slowed down. FPI outflows continue. And corporate earning by and large is meeting expectation for March 26. Net, we are likely to be a range-bound market till clarity emerges on the war. Our outlook remains neutral weight equity unless until you want to take risk by trying to capture volatility. Be overweight within that large and mid cap, and be underweight small cap as valuation remain demanding. From an investment point of view, we continue to add value to our investors by generating more return than index on a rolling return basis across our equity and hybrid funds. On a point-to-point basis, bearing small cap and mid cap, we have by and large generated alpha over benchmark indices. This is true across many of our hybrid and other equity funds. Similarly, on SIP, across majority of our fund, across majority of time period, we have generated positive return. We have generated outperformance over indices. If you look at FlexiCap, our first equity fund to cross 50,000 crore some time back, it's been a steady eddy performer, consistently generating better return than benchmark index despite size and delivering double-digit return for patient investors. Kotak Multi-Asset Allocation Fund also has delivered massive outperformance. This is a fund for giving or outsourcing your asset allocation responsibility to fund manager across debt, equity and precious metal. Multi-cap fund, which invests across small, mid and large, has also generated significant alpha on a point-to-point basis, rolling return basis and on SIP. These three funds, Flexi, Multi and Multi-Asset Allocation, can be considered in today's environment. Kotak Small Cap Fund has underperformed market peer group and index. This has been driven by regulatory constraint. MCX is a stock which is up 7 times in last 3 years. It's up more than 100% in last 1 year. It is present in many of our peer group portfolio, but we are not allowed to invest in MCX under SEBI regulation as a fund house. Undoubtedly, this has impacted our performance. We had applied to RBI to invest in 5 banks, which has done very well over last 1, 3 and 5 year. We have got approval to invest in these banks now, but that lag has created adverse impact on performance. Adjusted for MCX and banks, Kotak Small Cap is almost comparable to benchmark index as well as the peer group. On the passive side, we continue host of funds across market cap, large, mid, small, or smart beta, factor on momentum, low vol, alpha, value, quality, multi-factor. We also have sectoral and thematic as well as commodity and overseas fund. Thanks to response of our investors, all our global funds are now shut for subscription. They do remain open for any redemption. In the passive portfolio, large cap funds like Nifty 50 or Nifty Next 50, or thematic funds like consumption and banking, or smart beta fund like low vol are appropriate in today's scenario.
To start with the fixed income part of the call for the monthly, we have been having a very eventful journey for last 2 months, especially given what is happening in the global markets, especially with reference to Iran and US. So far, from the macro perspective, we had a fairly decent set of numbers. However, whatever has happened in the war and has led to the oil prices above $100 barrel, and it is sustaining at around $100 a barrel despite various newses coming in the market, sometime real, sometime fake, that things are settled, agreement is reached. In the morning that happens, in the evening again we are back to square one. So we've been living under this kind of circumstances for fair amount of time, and it is becoming extremely difficult to believe what we are seeing is real or unreal, and how it is going to shape up the future. In such kind of an environment, we are expected to give or throw some kind of number, what is going to happen, what are the likely set of macros, how they are going to move, and accordingly take a call on the fixed income. So till now, whatever we have from the hindsight and the history, let us have a look at that and try to gauge how things are going to be in the coming future. So in front of you, we have this slide for the US CPI. While the world over things are getting precarious and hostile, US things are pretty okay in terms of inflation so far, and nothing has been disturbing from any perspective, be it debt markets or equity. Things are pretty much normal, because whatever is happening around the world, actually in a way they are getting benefited, either by way of deleveraging in the emerging markets and the money going back to the US, or otherwise, because if you look at the interest rates or the markets, equity markets have been doing okay, and interest rates are also, whatever has happened, and nothing incrementally has gone bad because of the war. Ideally, what happened, they started the war, and they should have been the worst impacted country, but it seems that they are going to be one of the best. So if you look at the CPI inflation index, so far it has not been impacted, and it is fairly contained on the sloping downward move. However, the central banks are slightly cautious in the last monetary policy also, despite the evenly kind of vote in terms of cut or no cut. the tone was fairly cautious in terms of future move, because they don't know how the war is going to impact the US economy. On the other hand, if you look at the markets are forward looking, and they try to discount, as I said, what is going to likely to happen in the coming future. So versus 2 months back, when the markets were discounting rate cuts going forward for the not even this coming year but the next year as well, as you can see the chart, markets have started discounting rate hikes into the prices at this point in time. So that will be a complete kind of a U-turn from what was happening in last 2 months and what is going to happen. And there is a possibility that the US may start tightening monetary policy in order to contain inflation. Well, having said that, it is a $1 billion question whether the tightening of the monetary policy can actually bring down the oil prices or not. But given what has happened in the war scenario between the US and Israel, just tightening the monetary policy can bring down oil prices or not, I am not sure. So this is CPI inflation, headline CPI and the core CPI in India. And as I said, so far we have enjoyed a very good journey as far as the CPI is concerned, given the one of the best growing economies in the world and contained CPI. We were almost in a Goldilocks kind of scenario. However, this scenario should have actually led us to a beneficiary in terms of fixed income yields lower and the markets higher. The fixed income markets had suffered significantly till the war started, and after the war, fixed income relatively became one of the better markets after precious metals. However, the precious metals are also not done as good, but relatively it turned out to be better for the fixed income, and it eventually says that in terms of asset allocation, fixed income probably should be seen as one of the prominent players, because in such kind of volatility it is difficult to create stability in one's portfolio. So if you look at the hindsight, we have done fairly well in terms of inflation, but going forward, given the oil at around $110 a barrel, situation has changed significantly or likely to change, assuming if this number remains here for at least a quarter or more. And over and above that, from the environment side, I'm sure everybody has noticed we are seeing a reasonable amount of volatility in terms of heat. In terms of monsoon also, it appears to be, it is likely to be normal, and there is a possibility it can undershoot normalcy as well, and which is going to impact crops. At the same time, shortage of fertilizer and things like that are also creating problems, and therefore this is going to be an eventful year, and it will be difficult to find a unified direction where the fixed income or any markets are headed. So we have prepared a chart for you that given the kind of expectations in terms of oil prices, how we expect what is the kind of possible impact on the GDP and inflation and the current account and USD INR. So we were running around last year all we were around $70 billion a barrel, $70 a barrel on the crude, and the estimated growth, GDP growth, was around 720, inflation was around 430, and the current account was around 1%, and the INR rate was around 89.90. But if we take the same number at around $100 a barrel, the growth gets impacted by around 70 basis point to 100 basis point. Inflation shoots up by around 100 basis point or so to around 530. The current account deficit shoots up to around 1.2% of GDP, which is around 2.2, and at the same time USD INR should trade in the range of 91-93. However, it is trading at around 94 at this point in time, and the moment you go to $120 a barrel, situation changes even much worse, because the GDP growth slows down towards 6%, and your inflation shoots towards 6. Both numbers become at 6. The current account deficit goes to around 2.8, and the rupee dollar is expected to around 93.95. So if you can look at the chart, rupee dollar is actually trading at where it should be. However, the current inflation is way below where it could be. It's possibly likely to go, and the GDP number is also not showing. So the future, which we are staring for now, at least for next 6 months to 1 year, has got reasonable amount of volatile elements, and the key number to watch will be how the oil prices are likely to behave once the settlement is agreed, because these kind of situation, every now and then something or the other will keep on happening, and probably after the set even after the settlements, it will be difficult for the crude oil prices to go substantially below the current prices. Looks difficult at this point in time. And just to give a reference point, in 2013 our current account deficit shot all time at the high of around 470. Today we are at around, if these things sustains, we may be at around 260, 270. However, in absolute terms, it's a big number. So if you look at the liquidity is reasonable at this point in time. RBI is managing fairly well. Core liquidity in the banking system remains at around 4 to 5 lakh crore. However, it is a matter of debate whether this 4 lakh crore number is sufficient or not to manage such kind of overall large borrowing system. But given whatever is happening on the account of the oil prices, inflation, growth, etc., RBI or any central bank is likely to remain cautious and would like to constrain the economy from a free flowing liquidity, and which is what precisely is happening. Given the tightness in liquidity, external conditions, 10-year is trading at around 7% mark, which is pricing in reasonable amount of tightening sooner than later. What we were anticipating earlier in terms of rate easing, but this time around market is pricing in a fair amount of tightening at 7% mark. So if you look at the yield curve at 4th of April versus end of Feb, you can clearly see the maximum amount of impact has been borne in the 2 year to kind of 8 year segment, which is the belly of the curve. While the yield curve across has moved up, the front end 3 months, 6 months didn't move up as much because of liquidity in the banking system, and there's no rate hike in the near term. However, the remaining part of the curve moved up by around 20 to 40 basis point, depending on where exactly we look at. Indicates that markets were worried about what is going to happen from the inflation front, and where are the oil prices likely to remain settle down. And even if they settle down at around 100, I've explained the maths to you that this is going to have a clear cut impact on the fiscal and inflation, and definitely the GDP growth, which probably it's a double whammy. Growth is also likely to remain slow. At the same time, inflation are likely to remain higher, which is going to be a challenging time for the central bank to manage. This is a slide where we track the FPI inflows into the Indian markets. So FPI have been selling equities relentlessly for some time now. However, we saw a reasonable amount of flows in the fixed income market, but of late, once the war broke, the FPS have started selling the fixed income side as well, while the number was not huge, but FP has been seller in the fixed income markets as well. Whatever buying was done in the from the January onwards have been undone till now. Recently, in last 2-3 days, we have seen some amount of upticks. However, we have to wait and watch if they are able to sustain that momentum. So this is the slide in front of you, which gives the perspective on how things happened during the taper tantrum when the RBI came and hiked the MSF rate and the currency depreciated by around 20 to 25% between April, May to around July, October. The rate hike was not much, but because of the MSF and the liquidity, which the cost of liquidity, which was taken up to a double digit number to around 10.25. The 10-year, which was trading at around 7.25, shot up to around 876 and even showed a 9% mark for a brief period of time before it came down towards 8 again. So if you draw a parallel between 2013 scenario and now, some amount of pricing has been done already in the 10-year benchmark from 650 to 702. However, if RBI resents to tightening in the monetary policy, there is a possibility that 10-year may spike from the current levels, but it's difficult to fathom what kind of number it will be because some part of it is already discounted at this point in time. But if the RBI tightens much more than the anticipation, as I said, as I explained it to you, that around 100 basis point is already there in the prices. If it is indeed more than that, then it can go slightly higher. But in the previous instance also, RBI didn't hike repo rate. So this time also we don't expect the same. Probably it can be done through tightening in the MSF or tightening on the liquidity conditions, which can take the 10-year higher from the current levels, and in fact the curve across the curve the yields can move up.
Debt market, Abhishek did explain to you the outlook. In that, income plus arbitrage fund continues to remain preferred option as the tax rate applicable after 2 years is 12.5%. For HNIs who are paying tax in 35% plus category, this is most appropriate fund. Gold and silver are witnessing huge volatility. Repeatedly across our monthly outlook, we have advocate investment in gold, albeit with a cap as a percentage of portfolio. We also recommended silver investing towards early 2025, and both those calls by and large has worked. Gold prices normally should go up during wartime. However, it did correct from $5,500 to $4,600. This was driven by selling of gold by central banks of Russia, Turkey, Bulgaria, Kyrgyzstan, and lack of aggressive buying by Japan, China, India. The gold prices also get impacted by what happens in US Treasury. While policy rate in US are stable, market yields have gone up under the fear of higher borrowing to fund cost of the war. That pulled gold prices down. We estimate gold demand to continue strong, including jewelry and industrial per use, and also central bank purchases. No new gold mines are discovered in last 2 years. The gold demand and prices will also depend upon how Chinese investors behave. They have suffered loss in real estate. As I showed earlier, for 20 years, Chinese real estate hasn't moved. If they replace real estate with gold, which has delivered multifold return in 20 years, undoubtedly that will be very positive for gold prices. Silver continues to witness massive volatility. Supply has emerged across Peru, Argentina, Mexico. Demand has come down because of higher prices. We believe silver will remain range bound with higher volatility. If I have to summarize, There are few products which one should consider. One, special investment fund. Their returns and volatility will be, so returns will be lower than pure equity fund, and volatility will be higher than pure debt, but collectively they do provide less volatile return. Special investment funds require minimum investment of 10 lakh. They will be managing on long short as well as leverage basis across hybrid and equity. It requires special skill, and we hired a fund manager called Kalpesh recently. We will be launching our SIF in the month of June. Do consider that. Experience it by starting small and then eventually scaling it up. Performing credit AIF we have been talking about. It requires minimum investment of 1 crore. They are normally close-ended up to 7 years. They could be risk-wise debt-oriented or equity-oriented. Debt-oriented has more safety, more security, less return. Equity has higher risk and higher return. The performing credit AIF market does provide opportunity as a regulatory arbitrage between banks, insurance, mutual fund, pension fund, vis-a-vis AIF. Global fund, we have stopped for subscription, but we will be launching an AIF via Gift City to invest in offshore market. Every investor should look to diversify part of their portfolio across India as well as in offshore market. REIT InvIT are available in secondary market. Do consider investing in REIT InvIT to take an exposure in real estate and infra market. This is our most important slide, an asset allocation view where we remain neutral in equity market and overweight silver from a trading point of view and continue to maintain exposure in gold. Large, mid and small, we remain overweight large cap and neutral weight mid and small. Sectorally, our outlook remains equity neutral, gold overweight, silver neutral. Sectoral call, auto, healthcare, cement. Themes, financial services, consumption and healthcare. And funds to focus multi-asset allocation, multi-cap and flexi-cap.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.